Hello traders, welcome back to my YouTube channel. My name is Papa Lozapoketo and I'm so very much delighted to welcome you all back to my YouTube channel. This is a new video. If you have not yet subscribed to my YouTube channel, please do so. Hit the notification button and a kindly share for the YouTube algorithms. Actually, this is a new video. It's a very powerful video, and we know that I'm going to talk about sentimental analysis. I'm going to talk about fundamental analysis and technical analysis in the trading session, because this is the YouTube channel that I'm going to be talking about all that I've said right now on the data. So right now today I'm going to talk about technical analysis using the fair value gaps in the trading sessions. As you all know that we are here to incur profits rather than incurring losses as traders. We are here to use all the ways and means in order to incur profits, right? Those are the very simple ways that we are supposed to be using. And right now we know that using these methods and using the proper risk management is a very good way to understand how to analyze the trading in order to incur profits. So today I want to go strictly to the topic of today, that is actually the use of the fair value gaps. I know many people don't know about the fair value gaps, and I'm going to show you directly what are the fair value gaps used in the trading sessions, right? So strictly sit back and actually enjoy the video. So what are the fair value gaps? As you know, what I want to give you, what are the fair value gaps and how to use them, where are they applicable, and how can they mean how can they be meaningful in the trading sessions. So right now, what are the fair value gaps? The fair value gaps are actually market imbalances, whereby we can say the price has not yet fully gotten, but the price has not yet fully gotten its fully liquidity, right? That is a fair value gap. It's actually a market gap whereby that occurs actually where in a big difference between the closing price of a trading session and period and the opening of a new one. All right, so how do they form? Actually, a fair value gap, they form, it's actually when you see on the chart, right, like right here whereby I'm going to show you on the trading view, it's like a triple candlestick pattern whereby it forms on where the previous candle, all right, because there's a one that is a very big one actually at center. It's like a triple. When I say it's a triple one, there are actually three of them. So the middle one, so the previous of the middle one actually candles high, its candles high, and the subsequent one after the middle one candles low, they don't meet, right? They don't meet or overlap, right? I'm going to show you everything that I'm talking about here. So the space between this week, the space actually between these weeks are actually the fair value gap, okay? They form when there's a large candle with previous candle and a subsequent candle low don't overlap, all right? So I'm going to show you everything. So how can we actually apply the fair value gaps? All right, so number one, we are able to detect market inefficiencies and market imbalances, right? We're able, when I'm talking about imbalances, I'm talking about when the price has not gotten its fully matched liquidity, all right? I'm going to talk about liquidity for the people who are not understanding what the liquidity is. These are terms and terminologies that are used in the forex market, and I'm going to give you specifically the terminologies, because I've told you that I'll be talking about sentimental analysis, I'll be talking about a fundamental analysis, I'll be talking about technical analysis in the forex market. Remember, we are here to incur profits. We are here to use proper risk management in order to incur profits. No trader that is expected to get losses, but we know that in the forex market we can incur losses if you are not careful, right? So traders actually we can use fair value gaps actually in the entry of trades and actually closing of the trade. That is another useful way of using the fair value gaps, okay? And the other one is actually it can actually help traders to set a well-defined stop loss level. I know many people know how to set up stop losses and take profits. So the fair value gap can help you to have a setup of a very well designed stop losses. And another one, it can help traders to actually interpret the price action. All right. So we have two types of imbalances, as you know. I'm going to give you. So we have number one, a buy side imbalance. All right. A buy side imbalance, we can also call it a sell side inefficiency. This actually you can see it on a bullish market. All right. So when there's an imbalance in price delivery, okay, we sometimes you can see it. You can see it, and I'm going to show you on the charts, actually on the trading view. So when there's a price imbalance in price delivery here, the sellers are not as high as expected. This is actually a buy side imbalance. All right. It is not. So I want to give you another thing that you should know about the fair value gaps. All right. That we are supposed to understand and know. All right. The fair value gaps we actually focus. All right. We actually focus the fair value gaps that reject the price. Okay. So here we're dealing with the fair value gaps. These fair value gaps actually happen, and when it happens, the market will try as much as possible to occupy the space, and it actually rejects price. So traders, I want to open your eyes and give you and listen to me carefully here, that it is not that every fair value gap that it is important, right? When you're using something called a Dayling range, right? What is a Dayling range? This is a definition of a swing high and a swing low that you can have it on a trading pattern. So it is not easy. It is not every fair value gap that can reject price. That's something that you should understand. It is not all of them that it is capable of rejecting price. But as traders, we actually more focus on the fair value gaps that reject price, right? So when you're using the Dayling range, actually for those traders, here I'm focusing with the traders that understand the market itself and the trading chart. For the beginners to yourself, actually, we advise you to actually start trading sessions and learn more about these things that I'm talking about here. But for those who understand what I'm talking about, especially the Dayling range, right? We have different types of Dayling range parts. We have the premium and the discount area. Okay, we have a premium and a discount area. So the fair value gaps on the discount area rejects price more on the premium area. Okay, so traders, I want you to see what are the fair value gaps itself here on the trading view. You can see here, actually the trading view here, we are on a 1 hour time frame. Right, we are here on a 1 hour time frame, and I want us to start carefully here, and I want to show you how the fair value gaps are actually gotten here. How are they meant here? We have said that the fair value gaps, whereby it is like a triple chart pattern. Okay, it's like a triple chart pattern. So for example here, let me use something here. Let me use a rectangle. We have a triple chart pattern here, right? Whereby there is an imbalance here. We have the imbalance here, okay? But we have, so this kind of thing here. You can see this center candlestick, and we have this previous high and subsequent low, right? don't overlap. So you can see this one and this one, they are not overlapping. Hence formation of a fair value gap, where the price will actually retrace back and push back to actually occupy and occupy this liquidity, because this is a certain liquidity here. All right, and we have said that most traders, we must focus on the fair value gaps that actually reject price. So you can see here the price will be rejected on this point. So this point here, we actually focus on the fair value gaps that reject price. So here this is a fair value gap. We have very many of them. All right, so here we can detect market imbalances. We can detect the entry point of the markets. So for the people who need to, if you could have entered the price here, the market here, you can decide to enter a sell here. All right, because this is a clear definition of fair value gap. Well, let me show another one. Because we have very many fair value gaps we can see here. We actually focus on the whereby the only focus here is actually on the candlesticks pattern. For the people who understand the candlesticks, it's a very good thing that you should be understanding the candlestick anatomy in the trading sessions and the trading markets, because we are on the forex market, and these are the things that you should be encompassing yourself. Yes, all right. Now I want to show you this one. This is another one. Look at this anatomy, right? We have 3 candlesticks here, one and the other one here, the other one here. So this one, this end here and this end here, they are not overlapping. All right, it's like a market gap, whereby the higher the previous and the subsequent one, they don't overlap. You can see here and here. So you can clearly show that the market will come to retrace on this point here, right? It will come to retrace back and actually fulfill the liquidity. That is a very clear definition how it will come. Let me show you how it will come to occupy that space of liquidity here. Let me show you. You see, the market has actually come on this point here. All right, it has actually come to fulfill and to occupy the left out liquidity. That's how the market works. All right, that's how the market works. All right, we have very many ways to analyze this one. We have said that we are actually on a 1 hour time frame. We are actually on a 1 hour time frame. So when you compare the very many institutional reference points that you are supposed to be understanding, we have very many institutional reference points. We have the order blocks, we have the fair value gaps, we have the we have the double bottoms, double highs, double tops. Let me show you this one. This is another one. This is another one. Yeah, there's another one here. Okay, this is another one, because yeah, I think this is another one. You see this one, the previous candle and the other one, they don't overlap. So the market will always try as much as possible to get that liquidity. All right, to get that its liquidity. Yes. Let me show you another one. Let me show you this one. This one is a clear definition of a fair value gap. This one. All right, this is now a good one. Let me show you this one, how the market has actually retraced to occupy this left fair value gap, because it's a market gap. Look at this one. Did the market retrace back to this point? Yes. So if you wait for the market, it will take some time. It will actually take some time to wait for this to have a clear entry points. Right? So you've seen here? Yes. So this is a clear definition of a fair value gap. Thank you very much, traders. Please subscribe to my YouTube channel, share, comment, and hit the notification bell for the YouTube algorithm. See you to the next video. Thank you.